All right, so the recording has started. This is Sarah Porras. This is Thursday, April 8th. This is our Are We in a Real Estate Bubble 2020 versus 2008 presentation. And I have with me real estate agent Wynne Lord. She's with the Brook Group Real Estate, eXp Realty, and she did just under $10 million of real estate transactions last year in 2020. That she has put together an amazing, super interesting, short and very digestible and understandable analysis, graphs and charts of what's been going on in the real estate market, and are we in another real estate bubble? Because as everybody knows, real estate prices have gone insane in the last year, despite all the issues with the economy because of COVID. And nevertheless, the real estate is at an all-time high. And my fear, helping people who are in foreclosure and who have credit and debt issues, my fear is that we will hit another 2008 where there's so many people in foreclosure and so much trouble. So we're going to watch Wynne's presentation. It's 10 to 15 minutes tops. Then we're going to have a roundtable discussion. I have also with me attorney Katie Carey of Mancuso Carey in Rocky Hill. And she's going to talk about her experience because their firm is a closing firm, and they had the highest volume. Their firm had the highest volume in Connecticut last year and the highest volume in Connecticut last month as well, as far as closings and real estate transactions. So that's interesting. We're also hopefully going to be joined by James Allen, who is with Guaranteed Rate Mortgage. He received his company's President's Award for, I think, doing the highest volume. He and his team doing the highest volume of mortgages in the state last year. So we have some real heavy hitters here. Wynne, who did just under 10 million in mostly residential real estate last year. Katie, whose firm did the most closings residential closings last year, and James Allen, who does mortgages, and he has highest volume of his company, and so far in quarter one for 2021 as well. All right, take it away, Wynne. Go ahead. Otherwise, I'll talk all day. We are recording. Okay, if you're just joining us, we're recording, and I'll send out a link to the recording later.
My screen.
Not yet. There we go.
A little bit.
Okay, we can see you.
Well, thank you so much for coming to my presentation. As Sarah said, my name is Wynne Lord, and I'm a realtor with Brook Group Real Estate at eXp Realty. And I know the two most commonly debated topics are religion and politics. And so today I'm actually introducing to you guys a third topic that you might want to bring up next time you're out to dinner. It causes a lot of debate, and that question is whether or not we're headed for another 2008 housing bubble. Okay. All right, so for me, I think that many of us in the industry have different opinions about where the market is headed. I'm definitely a big fan of making sure that I have data before I give my opinions on this market. So today, the data that I'm actually presenting on is data from back in 2006 versus 2006 to 2008 versus now, and just the past couple of years. I'll actually be showing very generalized data across the US because I do believe that the housing shortage that we see is everywhere. And I'm also going to go almost on a micro level too, and just talk a little bit about Connecticut, and then even specifically to certain towns in Connecticut. So the question again is, are we headed towards another housing bubble? And so let's compare the 2021 mortgage standards versus 2028. What I'm showing here, it's called the Housing Credit Availability Index, also known as HCAI. And that basically measures the percentage of owner-occupied home purchase loans that are likely to default. And default simply means that, it's 90 days of not paying your mortgage. And then that, the homeowner goes into default by then. And so this is what the lender risks that they're willing to take on the buyer. So if you look, prior to 2008, we've got a real high standard where the lenders were willing to tolerate, defaults and also taking more risks on that home buyer. Whereas now we're definitely dealing with a much lower HCAI, which simply just means that it's more difficult to get a loan. And as a realtor, I actually see this quite a bit. I see homes coming, back to market simply because the loan didn't go through. And so that's why if you're a home buyer and at this, class right now, it's great to get a pre-approval versus a pre-qualification, because a pre-approval simply means that the lender has done all of his or her work needed prior to ensuring that you making an offer and that the loan is going to go through. So it's really good to have all your homework done beforehand versus like middle of the loans going through and then all of a sudden it's like boom, you don't get the loan. So
Yeah,
real important to get that done.
Sort of talk more about that, Wynne, pre-qualification versus pre-approval, right? If I'm looking to put an offer in on a house and I just have pre-qualification, what's going to happen right now in this crazy market?
Pre-qualification basically means like, you've told your lender like, oh, I make $150,000. Or, you send them, just a couple of statements, but they're really not like into the nitty gritty of like, okay, so what else do you have? Do you have a second mortgage? Do you have a new car that you just purchased? Those are certain things that have to go into underwriting to make sure that you're actually, pre-approved. And basically pre-approval is just a much stronger version of the pre-qualification. It simply means that the lender has done all of his or her homework to ensure that you're still going to get to closing. Now, they're also not responsible if you just go out and like just buy a new car or like go and ruin your credit like during the middle of the purchase. But for the most part, they'll typically advise their client on what to do and what not to do. Question, Sarah?
That's great. Keep going. Thanks.
Okay, awesome. All right. So number 2, we have supply and demand. So 2021, the reason why prices are much higher is simply because the supply is down. So let's actually look at the inventory from 2007. So in 2007, we actually had almost 10 months worth of inventory of existing single family homes for sale versus now 2020, last year, we had about 2 months worth of inventory for sale. And if you want to go on a more, I guess, micro level, I actually went on a listing appointment a couple of weeks ago in Windsor. And I wanted to show that potential seller who did end up signing with me, but I wanted to show her like what her competition looked like in Windsor. And so this is the MLS. This is what I see on my end as a realtor. And so when I search for different parameters for clients, I go, looking at $300,000 to $350,000 homes, single family in Windsor, Connecticut, that are currently active on the market. And I'm showing up as one match. There's actually one house out there in Windsor in that price point, which basically goes to show us that we're actually in a less than 2 month worth of inventory. This is about like less than even 1 month worth of inventory right now in Windsor. So again, this is why it's like, if you're a seller out there kind of thinking on the fence, this is your competition. You have one house on the market, which is again, a great time to sell. Let's look at data again, 2008 versus now. Back in 2008, there was a ton of new construction. We still also had a lot of inventory for homes that were already built, but contractors and builders were actually still building homes back then. Versus now, we're looking at, pretty much not much inventory out there. And even the new construction, it's still not filling that void that we need. So, materials are expensive. It takes a really long time to build. And so that's why we just don't have, much new construction now either. Us that we have a low supply. We've got affordability. So as much as we complain that it's expensive to live in Connecticut or in the Northeast, houses actually aren't as expensive as you think. So let's first talk about, what is affordability? So it's 3 factors. 1 is the price of the home. 2 is the wages earned by the purchaser. And then number 3 is the mortgage rate. So again, let's compare 2006 versus 2021. In 2006, we're looking at a higher price of the home. We're also looking at lower wages, but we're also looking at a higher interest rate. So mortgage rate greater than 6%. Versus now, 2021, we've got a higher price for the home. We also have higher wages, but we also have lower interest rates. So basically what this graph is showing is that the average homeowner actually pays less of their monthly income towards their mortgage payment now in 2021 versus back in 2006. And again, like affordability. So like we live in the Northeast, right? So as much as we complain like that, West Hartford or Glastonbury or South Windsor, the pricing is super high, but what you're also getting is a really good school system. You get great public resources. And so in that sense, I actually feel like the Northeast, we're actually coming to, a pricing where it really should have been, I just feel like we have not fully recovered from back in 2008, if that makes any sense. 5, the slide that I'm showing here is showing that in 2021, homeowners also have much more equity than we had back in 2008. So in 2021, again, you guys have all seen this, home prices have steadily risen over the past few years, and that's allowing people to actually have more equity in their homes. So during the housing crash, what people kept doing is they kept refinancing. They kept refinancing the equity out of their homes, simply like they were ATM machines. And so when housing values began to crash, the homeowners were actually in a negative equity situation, which ended up causing lots of foreclosures and short sales. So let's compare the data. So back then, again, we have a total of about $824 billion of people refinancing, versus now the past, like 2018 to 2020, we're looking at a total of $348 billion. So we're looking at a difference of almost $500 billion of people that refinance, less now than back then. And now let's actually talk about home appreciation, because you hear about people who are bidding like 20 to 40,000, even $100,000 over, asking price. And so this is just comparing, between 2002 to 2005, we've got an average annual appreciation for homes of 10.3%. And then now 2017 to 2020, we're looking at an average annual appreciation of 6.3%. And clearly 2020, COVID hit, we're all working from homes. We have that need for an additional office. We have that, need for a pool or a finished basement or whatever it might be. So I definitely see like the home appreciation increasing simply because we just have that serious, demand and a lack of supply for homes. The year-over-year change in price. So this is again on a national level. For the United States last year, we're looking at a 10.8% increase of change in price. And as you can see in the Northeast here in New England, we're at 12.6%, West Coast 11.6%. These are, good data to compare versus 2005 Q4. You see a really high, difference of the year-to-year change in price. So we're looking at increases within just a year of almost 20% on the West Coast and mountain area, South Atlantic 17.8%, and again we're looking at a 13% increase. So those people that have purchased even last year or the past 2 years, you're looking at pretty much 5 to 10% of equity that you already have built into your home if you bought last year or the year before, which is pretty cool. Get asked a lot, and I'm sure Sarah can maybe talk a little bit more about this. But the question that I get asked is, hey, should I wait to buy because I feel like we're headed towards a lot of foreclosures, or are we headed towards lots of foreclosures? And so last year, when the forbearance, law came to place, there were quite a bunch of people that did file for forbearance. But right now, as of February 14th, 2021, we're looking at 50% of those forbearance people that ended up paying in full. 33% of that, they're working out some type of repayment plan with the bank. And then we have 15% that are still in trouble. So that's about 85% of people who are either paid in full or working towards paying, getting out of that forbearance. And then of course, unfortunately, we have the 15% who are still in trouble. Now, if we take that 15% and look at how many homes that actually equals out to nationwide, we're looking at about 325,000 people or homes that will potentially be filing for foreclosure by either the end of this year or early next year. And so if you look here though, if we add that 325,000 homes for this, this year, we're still looking at an undersupply or lack of inventory of homes, which is crazy. Do you guys have any questions so far? If I'm going too fast, let me know. So basically, my conclusion based on the slides, are we approaching a housing bubble? I think that there are definitely similar trends from 06 to 08. but the overwhelming information shown is that the home buyers now actually have a lot more equity than they did back then. And I think, you know, even if there were to be a drop in prices, we still have enough equity in the homes to be able to weather a dip in home values. And I think that the proper terminology here that we want to focus on, is actually the word market correction. So by market correction, it simply means that, like Connecticut, we are actually back to the prices where we should have been because we never actually recovered fully from 2008. So I think instead of housing bubble, we really should rephrase things and call it a market correction. I think that is pretty much it, guys. Do you guys have any questions?
So Winnie, it's funny that you mentioned market correction when you stopped, because I did take notes about the appreciation graph that you showed. And if you notice, 2006 to 2016, the statistics are missing. So I'm wondering if, like you said, rather than having a new bubble that we're approaching, is we're seeing that correction. So maybe those prices are just starting to settle back to where they were back in 2005.
Leaning towards, yeah. And I think that as more inventory comes, we'll definitely see, hopefully, less of people, you know, bidding $100,000 over asking price. But I think what's going to happen, it's going to end up kind of like flat, you know, flatlining a little bit more after next year.
Yeah, I tend to agree with you. I think my biggest thing, and being the devil's advocate in some positions, I do think that we are headed for a second crisis in real estate. However, Sarah, when you presented the lunch and learn, you said, is this 2005 versus 2021? 2008 versus 2021. I would suggest that we're in a similar position as to where we were in 2004 and 2005, where the market's still going to continue to increase, because 2 months ago, I had a client buy a property for $320,000. Well, unexpectedly, she had a job change and has to leave the state. Just listed the property and sold it in a few days for $150,000 more than what she closed for in February. So there's some serious inflation in prices that we're seeing now. And I think if those numbers continue, I don't think we're going to have a crisis this year. I don't think we're going to have a crisis next year. But 3 years from now, we're going to have a crisis on our hands, because this person that's paying $150,000 more than what a property appraised for 3 months ago at 320 is going to be in a position where they don't have any equity to refinance. They're paying mortgage insurance that they can't afford. And if the economy shrinks in any way as a result, I mean, once the PPP funds are gone, businesses start to have to shrink because we don't have the government reliance that a lot of businesses are depending on now. We're going to see job loss. And these people that have these mortgages that they paid for, you know, $100,000 over asking or $50,000 over asking, and are paying mortgage insurance payments of $300 or not getting any equity, are going to say to themselves, do I want to keep giving my money away, or do I want to just walk away altogether? So I think in the short term, I think 2021 is going to be great in real estate. I think supply is going to remain low, but in the next 3 years, I think we're going to see a real turn.
You know, the way I read some of these statistics, you know, when on the prior slide, when you put that up, do you mind putting that up? Just the one, just go one back with all the, whether, you know, your conclusion of market correction, and that, right? No, yeah, that one. I think that when you say not because people can just qualify for a mortgage, right? I feel like I bought my house in 2004. And I was obsessed with real estate values following that. I wanted to see my house increase. I wanted to make sure I did the right thing. And I think 03, 04, 05, 06, 07, it was insane, like month over month property, you know, value increases. And I think that what people were doing then was they were taking that increase and they were cashing out that equity, right? So if they bought their house in 03 or 04, within 2 years, they had, you know, 25% equity in that property that they shouldn't have had, right? If they just paid their mortgage, they might have had 10%. And they cashed out that equity. And then there was the crash of 08. So they were making less with a higher payment because they took out equity. It's less equity to rely on, right? You couldn't then refinance again. And I think that's what led, among many other things, to the foreclosures I saw, was refinances that happened because of this perception in increase in property value. And as Winnie's first chart showed, more risk in the lending products, right? Much more risk with these no documentation loans, right? You didn't have to prove it was what was it, stated income, right? You just had to say you made a certain amount of money. And that's the red, right? Those are the loans that were given red. It's too bad James is having technical problems today, because he could go on for another hour.
I'm here.
Oh, you're here. Excellent.
I'm on my mobile. I couldn't get my computer to work. Sorry about
Excellent,
that.
excellent.
Still,
Okay,
still
great.
down.
Okay, good. And you're in as me, but that's really James Allen. So maybe we'll give the floor to him for a few minutes to talk about what he's seeing as a very high producing mortgage processor. So.
Yeah. Okay. So, I don't know what I think is the honest answer. I think that there's strong arguments on both sides, and I respect both Wynne and Katie. I'm a person who looks at data generally and makes decisions based on that. This is what I can tell you. If you look at the rise in delinquencies, so you've got to kind of parse out big picture delinquencies versus small picture delinquencies. Big picture delinquencies are actually down year over year. Big surprise. Like, we're down 0.7%. Now that's across all product types, right? But what you have to really realize is the product types that are most likely to have delinquencies are up significantly. So you've got to look at where COVID had the biggest impact in terms of economic classes and folks that would typically get certain types of mortgages. So if you look at the big picture, it actually doesn't look that bad. I think Winnie's general idea of where we're at is probably fairly accurate. But if you start to drill down to some of the metro areas where you've got high volume of FHA financing, well, now you start to see some scary stats where they look remarkably similar to 2008. Actually, if you look at 2008, we went from an 8% delinquency rate to 14 in 1 year, right? So that's a sizable jump right there. Well, right now, the delinquency rate of FHA loans nationally is 17.5%.
Can I insert something here too, just from my perspective of
Yeah.
going to mortgage conferences, for being a consumer attorney, and I attend these national mortgage conferences. One of the other things that's happening with FHA is that they're selling pools of loans onto the open market not long after they fund. So I think that they're getting into riskier borrowers because they're going to wash their hands of it anyway, which is not something FHA ever did before. So. And then the risk there is you think you're getting an FHA when you're borrowing, you think you've got the protection of sort of having some protections that come with FHA mortgages, especially when you become delinquent. And those are no longer there once they're sold out to a debt buyer, essentially, on the open market. So let me just say that could be one of the reasons the delinquency rate has gone up, is FHA is being less careful and selling off to companies that are not helping keep people stay on track.
Yes, servicing contribution is a factor for sure. However, what they're selling is the security. They're not selling the insured product, right? So the FHA insurance policy still applies to those loans laterally, like the way it has in the past. What's really interesting is HUD is ultra cash rich right now, right? I mean, if you look at what was in the HUD insurance policy back in 2008, I mean, they were almost bankrupt. Now they have billions and billions of dollars, and everybody's lobbying for them to lower mortgage insurance premiums in order to actually reset some of that, and they're not doing that. And I think they're not doing that probably because they're anticipating a strong need to use those funds in the season ahead here. But if you look at what I was talking about, delinquency rate in 2008 going from 8 to 14, well, this year we've gone from 11 to 17.5% in this particular sector of mortgages. It's a 7% increase in in just 12 months here. And Connecticut is among the highest delinquency of all areas. In fact, Connecticut's higher than the national average of 17.5. Our high metros are all at 20 plus percent. Stanford Bridgeport's at 21%. We're one of the highest delinquency rates in the country as it relates to HUD loans. And how they're measuring this is people who are 90 plus days late on payment, right? That's what's seriously delinquent. Not 30, not even 60, 90 plus days late are considered seriously delinquent. And so we've got trends where what we're seeing is the delinquency rate is really similar to what it was before. Now, the causes, so cause and effect is really important to consider in this case. The cause of 2008, we've already talked about. It was that people were put into products that they should have never been put into in the first place, right? They didn't have the job that supported the mortgage payment, yet they took the mortgage, then they couldn't pay it. That is drastically different. People now actually have jobs where they can support the mortgage. And the reason I know that is because it's near impossible to get a loan if you don't meet ATR. I mean, unless you're going to unless a borrower is going to blatantly commit fraud, the ability to meet, the ability to repay laws make it near impossible for a person to get approved. Now, FHA, everybody knows, is more flexible in terms of lending standards. That's true. They allow a higher debt ratio because of the insurance product. All that stuff is true. But you can't just walk into a bank and get a loan today. There's a tremendous amount of effort that goes into documenting the validity of an FHA loan. And so I think the big difference is this: COVID is not people getting loans that they can't afford. COVID is people being put into a temporary, if not long-term, hopefully not long-term, but at the very least, a temporary position where they can no longer pay the loan. And so the forbearance laws that have been passed, I actually think, as much as I don't like it, because I'm a guy who's in the mortgage industry and it impacts what I do day to day, I actually think for the consumer, which remember, I am a consumer at the end of the day as well, I actually think for the consumer, that's a really positive thing that has helped prevent foreclosures. I think a lot of these people will get on track again in a relatively short amount of time. And that is a huge difference from 2008. 2008 was, they were never on track in the first place. They bought a Lamborghini when they should have bought a Honda, right? Should have bought a Honda, but they bought a Lamborghini. And in this case, now we've got people who they bought Hondas and then they lost their job, right? And I think that that's drastically different. What we're seeing is that, you know, we've had record months of jobs coming back to the economy. This last month, this is interesting. We're down for the first time in 3 months on the jobless claims, or up, I should say. We've got more jobless claims this month than we've had in several months. The Fed is clearly supporting inflation right now. They're allowing, or, you know, we're projecting a PPI index increase. That's a producer price index of 3.8% next year. That's basically cost of goods across the United States increasing at a rate of about 4%. All of that stuff is driving value up across every sector, of which housing, you know, is a primary. But at the end of the day, you know, the question is, are we approaching a bubble? For it to be a bubble, it has to pop. I think it might be more like a balloon than a bubble, in the sense that it's inflated. But once COVID is over, the people who qualified, if they're able to get back to relatively similar jobs, and if legislation gives them the opportunity to make good on the loans that they took, I think the majority of those people will. I don't think we're going to see foreclosures in the same way that we saw them in 2008. We will see a wave, undoubtedly. There will be foreclosure properties available. That's true, because some people who made 80,000 before, now they only make 40 because that's the only job they can get. That's going to happen. But that's going to be significantly lower than millions and millions and millions of churned people who bought houses that they never had any business getting in the first place. I'll stop there.
I want to open it up. Almost everybody on this call is muted. If anybody has questions, feel free to unmute yourselves, or if you can reach me, if you can't unmute yourself, to let me know you want to use maybe the raise hand function, and let's shoot out the questions for Wynne Lord, the real estate agent, Katie Carey, closing attorney, and James All, the mortgage broker. Who's got questions or comments? Go ahead, Mr. Alexis.
Yeah, what do you think about the multifamily industry? You think it's going to be more foreclosures, or it's going to like balance out?
Who wants to take that one?
I would imagine, so I can tell you without a doubt, the forbearance rate of multifamilies is relatively similar to that of single families. However, those properties generate cash flow, and typically a healthy multifamily is going to have itself paid for with the actual renters that live there. So unless you're dealing with a moratorium situation where your renters are not paying you, I don't think you're defaulting on that property.
My question too, to tail on that, is, are we seeing the same frenzy with multifamilies and condos as we are with multifamily? I mean the 1 to 3 or 4 family that's typical here in central Connecticut. Are we seeing that same frenzy as with single family homes?
I tend to think that the multifamily market is pretty, I mean, it's always busy. It's always strong. I mean, even if you asked me 2 years ago about, you know, the West End where I live, in a multifamily, property were going in under a week 2 years ago. I mean, now they're going in a day. So I don't think it's that much of a difference in the but I mean, I guess that's specific to Hartford too. So I should let Wynne speak to it too.
I mean, you know, Hartford, New Britain, those are really hot markets for multifamilies, and same, I feel like it hasn't changed. In fact, it's probably just gotten even hotter, like Katie just said. Yesterday, I just helped a cash buyer purchase a condo for investment property. So I feel like investors, like, they're definitely taking advantage of, you know, being able to have a lot more like liquid cash to make an offer and win. So
Part of what made 2008 so dangerous was that people were in mortgages on houses they couldn't pay for, and then they couldn't sell those houses. Now, at least right now, people who are feeling the real significant burden can off those houses very quickly,
We have
especially
another
multifamilies.
question as well. If we're done with that, I don't want to cut anyone off. We have another question, Greg. I'll unmute you. I can. I cannot unmute you. Maybe if you can type your question in the chat or find your unmute. I don't know if you're on a phone. While he's working out his technical issues, does anyone else have a question right now? You know, the reason I was concerned, as everyone knows, I help homeowners who are in foreclosure. The first thing a year ago that I started feeling about this compared to 2008 was, I hate to put it this way, this is no one's fault. Okay, in 2008, 2009, I was already helping people who were in foreclosure, so I've been through both of these waves. What I saw in 2008 was how people were treated if they couldn't pay their mortgage. They were just treated like dirt. They shouldn't have, like, you bought a Lamborghini, you should have bought a Honda, right? That was a terrible, and I think that's rooted in our capitalist economy and our kind of our entire country's attitude towards money is, you know, pull yourself up by your bootstraps. You shouldn't have done that. You know, you made a bad decision. But now this problem, if people are falling behind on their loans, is because of the economy that everybody was affected by. So I find it interesting that well, and so therefore the government is forcing the lenders to be more cooperative. Many federally backed loans, FHA, Fannie, Freddie, USDA, VA, have mandated forbearance plans and ways of dealing with the way the loans are falling behind. You know, I do hope, as James said, that we do not see the mass of defaults and that people can get back on track. And I think it's going to be down to whether the servicers are going to do it right, whether the servicers and the lenders are going to allow people, they're going to have a common sense approach and are actually going to be, appropriately allow people to get back on track. Greg, I see you're now able to talk.
Yeah, sorry, I had to fix my phone settings. So my question to the group is, I'm in a condo in Vernon that's about to have the concrete replaced. Does the group think the value of condos are going to rise after the work has been completed?
That's a crumbling foundation situation he's talking about, I think.
Right. I'm in Ryefield.
Okay.
The answer is yes.
Right. Oh, sorry. Yes.
Yes, I think so.
I agree too. I mean, I know Ryefield, they typically are like 180 to 210, if I'm correct, like purchase price. So the value of them now, I'm not sure what they are, but I think that, you know,
They're hovering near 100,000.
Well, you're talking about at present with the defect, correct?
Correct.
Yeah. So I'm probably the only person who has like significant experience in financing these condos. I mean, just like happen to be the guy who knows how to do this stuff. You can sell it now, right? And there's lots of people who will buy it if you want to. And I know that the challenge for most people, and Sarah's like an amazing resource on this, so I would, tell you to talk to her. People are always trying to figure out, what do I do? Do I keep this place? Do I walk away from this place? Do I sell this place? Do I wait and have it fixed? Those are all things that you should consider, but you can sell it now, and people are doing that. If the buyer can acquire the property at the price and value with the defect included, and the appraiser determines that the work is not imminently required to be done now, in addition to the actual foundation engineer, concrete engineer, right? As long as those three parties collaboratively work together, we move a lot of those properties. But to answer your question, I think you're saying, hey, this work's going to get done. Should I hold out and sell this property?
Weeks.
Yeah, I mean, if you're 3 weeks out,
start. Yeah.
How long is the project going to take?
3 months.
And Greg, which building are they lifting?
Well, they started with 19. I'm in 15. which starts, I mean, they're starting almost one a week now, 2 companies doing the work.
Wow.
What's the cost of the assessment that you're paying? Are you paying any assessment or is it fully insured?
It's gonna cost me 6,100.
Then there's no question. I mean, your property is going to increase by roughly 70% value in 90 days, and there's no forecast that we're going to see any kind of decrease in actual. There's no forecast that we're going to see a decrease over 90 days. I mean, Winnie, correct me if I'm wrong, but all the FHFA data, I got the housing price index on the screen in front of me. I've been tracking the last 10 years. To go back to the point they made earlier, we're actually right in line with where we should be. We're not inflated at all. We're actually right where we should be if we had natural progression. But there's no sign that this is going to stop. We've been increasing at a rate of 1% per month for 13 months straight. And there's no sign that that's going to stop this year. So I think you're going to have a really good out to get out of your condo in just a couple of months here. And you should have Winnie listed because she's going to get you the most money for it.
And if I can nerd out on Ryfield and crumbling foundations, and specifically, Ryfield's huge. And my opinion a year ago, 2 years ago would have been, well, owning in Ryfield is some of the buildings are fine and some of the buildings need work. And a year or two ago, there was no plan to lift any of those buildings if they were over a certain size, and most of them are. And you as a unit owner, even on a foundation that's fine, we're going to pay the price for the fact that there's foundations that aren't good. Either eventually those buildings were going to fail, you'll have empty property right there in your complex, or your assessments were going to be so high because the building's not affected, we're going to have to fund the buildings that were affected. It was going to be millions and millions. So it sounds like you guys have figured out a way to make it affordable. And again, there's the what do you call it? I'm losing my words today, but when you own a property and yours is fine, but some others are not, you're affected, you're negatively affected by that. And I can't remember what the word is for that when you're influenced. Sorry. So we're at 40 minutes in today. I'd love to take more questions. I want to sort of do a hard stop in 5 minutes though, just to let everybody get on with their lunch and with their day. Who else has questions about these topics? Thank you for that question, Greg.
Thank you.
Loda Nicholson has a question. Sarah, if you want.
Oh, let me unmute. Sorry. There you go.
Hi, Sarah. Can you hear me?
Of course I can, Loida. How are you?
I am well. Phenomenal discussion today. I really appreciate Katie and Winnie, and James is just a numbers crunching machine. I love what you guys have been sharing. I'm a real estate attorney. I do primarily represent purchasers. I'm a little confused when we start talking about the that the inventory is really low. If the inventory is really low, what does it mean for me in terms of my business and contemplating how much business I will get from buyers? Is it that there won't be anything available for buyers? So I'd like any of you to weigh in on that, please.
Sorry, I couldn't quite hear you. Could you please repeat what you said?
That the inventory is super low, but it's simply because the demand is super high. And so, for every one house that's out there, there's like 5 to 25 offers on that same house. So I think, I look at it like based upon like a scaling, scale system where, there are homes out there. It's just, there's not enough homes out there to meet up with the demand.
Okay, I'd like to follow up on that. And thank you, Winnie. In my demographics, they're primarily, they're FHA borrowers. So if you have an FHA borrower versus a non-FHA borrower, and that non-FHA borrower comes in pre-qualified, what have you been seeing in the trends as to which buyer the seller would accept? Which between the FHA and non-FHA borrower?
Yeah, Winnie writes offers, but I probably supply letters for more offers on a single weekend than anybody else on this call. we'll do 40 offers in a weekend, and I see FHA offers accepted regularly, and I see VA offers
Okay.
accepted regularly. I do think that there are certain professionals who lack education and make disparate decisions that are not cool. But that's really the ethics of the individual more than the reflection of the market in general. And to go back to the whole supply and demand dialogue about your first question, obviously, how can you project out the year? Well, you really can't. But when there is high demand, supply follows. I mean, that's the cycle and laws of actual economics. So right now we've got high demand. You have to also remember why the supply is low. The supply is not low because there's not enough houses. There aren't enough houses. That's true. And Connecticut is specifically worse off than other markets because we have 10 million New Yorkers moving into Connecticut right now. That's all true too. However, this is a national problem. This is not a thing that's just happening here. We're seeing this in every single market across the country right now, right? And we've got people who are ready to buy, they want to buy, but they can't find that inventory. Well, this is the reality. As the economy recovers and we see inflation continue, which the Fed is clearly supporting by continuing to buy bonds at a pace of $40 billion per month in light of 4% inflation this month, or projected at anyway, we're going to see that supply come to the market. It's going to happen as COVID fears calm down over the next 6+ months, as vaccinations become more widespread, and there's a general comfort with returning to normalcy. The supply is going to come back. And at that point, I don't know if housing prices will go down or not. That I can't predict. But what I will say is that the number of transactions will exponentially pick up. I think if I had to make a prediction, and this is total speculation, I'd love to hear Katie and Wynne's thoughts. My assumption is that our spring market basically started in January, but it's not going to stop until December this year. In other words, it's crazy all year. I think when the inventory pops in late summer, we're going to have wild late summer, fall, and winter months during a time which is normally slow down. All the inventory is going to be there and people are going to start to move. And there's a lot of people who are ready for that. But that's my 2 cents.
So there's one thing I want to go back to the original question about an FHA versus a conventional buyer, because there's something we didn't really touch upon. Before, when James was talking about risk, he mentioned that, mortgage lenders, by and large, improve their program. So they're not giving out high risk loans. That doesn't mean that our buyers aren't necessarily taking risks. A lot of what we're seeing, and I'm sure Wynne and James can attest, is people are waiving appraisal contingencies, which means if they make an offer on a property, say 365, and it comes in at 320, they have to come up with that balance due. And that just happened to a client of mine. So they're taking that risk, they're waiving that appraisal rate, and they're already putting themselves underwater in the beginning. And then going back to the question of an FHA versus a conventional buyer, someone that's able to waive the appraisal contingency is going to be a more attractive buyer than an FHA buyer who has an amendatory clause that says if it doesn't appraise out, they get an automatic out. So then they get their deposit back, and the seller's lost that time in the market, unless they can come up with the money. Whereas most FHA clients aren't coming up with $35,000 or $40,000 to bring to closing. So I think that is a disadvantage. I mean, that's something that sellers are looking at. I mean, that's what I advise my investors when they're selling their properties. If they come to me with that, and it is a risk that we're going to see be more problematic in the next 2 or 3 years, when these people that maybe offered $40,000 and paid $40,000 over asking are looking to refinance to get rid of their mortgage insurance, and they just can't because there's no equity. So it's definitely something to consider. And as a real estate attorney, what I would recommend is if you did have clients that purchased in the last 3 years, reaching out to them, looking at their interest rate and seeing if a refinance makes sense for them. I did, and James can attest this, we've had a lot of clients that bought 2 years ago, FHA, that were able to get into a conventional loan because appraised values are higher now. So they were able to get in that niche and reduce their payment, get rid of their MI. And, and as long as they're willing to stay in that property for 5 or 10 years, they're going to make all that money back. So that's definitely an opportunity for you if the market's shifting from purchase to try to find those clients that are looking to refinance.
Thank you so much. And I just want you guys to know I love Sarah Porras. She just gives and gives and gives us what's really important, whether it is to expand our market share, but just caring about the well-being of all of us. And I would like, please, I jumped in on this really late. I got in about 5 minutes late. I don't know if Sarah posted the contact information for you, Katie, and you, James. I certainly had got Winnie's information when she put up her card. But is that something that you're willing to do to make your contact information available, please?
I'll have them
Yeah, I'll put it.
chat right now. The other thing I'm gonna
Okay.
do is I'm recording this. We're gonna
Katie, can you put mine in there too?
I'm gonna stop this in a minute, but when I send out the link to everybody who registered, I'll make sure that everybody's contact information is in that email with the link to watch this again for anyone who had to join late or leave early. So thank you,
And
everybody. Thanks.
thank you all. Yeah.
Thanks, Loida. And I did not.
Just one
pay her
comment to
say that.
piggyback.
I didn't pay her to say that. She's too kind. So thanks, James Allen, Wynne
Well,
Lord.
Sarah, we all feel that we all feel the same way about you, Sarah. So we know you didn't pay her. Can you hear me?
Yes, I was like, you're gonna compliment me too. So thank you.
I wanted to piggyback what Katie said just for 1 second, because if you're worried about transactional volume right now, she just gave you a golden ticket that you might not have picked up on. If all of your past FHA clients have the opportunity to refinance, eliminate mortgage insurance, get into a conventional product with a property inspection waiver, and you can get that back to mortgage brokers, you have the potential to bury yourself in transactions that are refinance related, but also add massive value to your partners, because some of your people are inevitably going to say, wait a minute, my house is worth what? I can sell this. Maybe I should sell. Maybe I should move. And that will give you massive referral opportunities to pass some of that business around too. So just as a, if that's helpful for you, it's something to be aware of.
Great idea to just improve people's lives by refinancing to better terms and getting away from FHA, PMI, and other things. So, all right, thanks everybody. And let me know if you want us to expand on this or do other lunch and learn series. Give me topics and I'll try to set it up. All right, have a good day, everybody. Thanks again.
Thanks, everyone.
Bye, guys.
Thank you.